Welcome to our channel, where we cover anything and everything in the car industry. If you enjoy cars and wanted to stay up to speed on all things automobiles, please like, share, and subscribe to our channel. According to the Wall Street Journal, Carvana appears to be on the verge of bankruptcy because the yields on its corporate notes are over 30%. After a significant drop this week, the stock price has increased in early trade on Thursday. Despite this uptick, the price has dropped almost 98% from its all-time high of $377 in August 2021 to little over $4. Right now, things don't seem good for Carvana. In response to bankruptcy rumors, the stock has fallen precipitously over the last 5 days, falling 52.54% from the end of last week to Wednesday's market close. The stock price dropped by about 43% on Wednesday, which was the day with the largest drops. The losses coincide with the circulation of speculations that the principal creditors of Carvana have signed a contract outlining the procedure for negotiating a restructuring in the event of bankruptcy. In other words, it seems the internet used auto dealer is getting their ducks in a row in case they fail. Although the result has not yet been verified, it is becoming more and more likely. Even though the price declines this week have been severe, Carvana has seen volatility before, with the stock down about 98% so far this year. Why has the price of Carvana fallen so much? The COVID-19 pandemic caused the stock of various firms, including Carvana, to surge. Credit was still affordable at the time, and global lockdowns had all but halted the production of new cars. It significantly increased demand for used cars and sparked a significant shift toward internet commerce, including for automobiles. For obvious reasons, the thought of skipping a trip to the dealership during a global pandemic was appealing. Due to government-mandated closures, even customers who wished to visit a physical dealership were unable to do so for several months. By enabling clients to view and buy used automobiles without ever leaving their homes, Carvana tapped into this trend. By the end of 2021, Carvana was presenting itself as a significant success story. Their first ever quarterly profit was revealed in their Q2 results announcement, and in August, the stock price reached an all-time high of $377. It closed at $4.04 yesterday. How then did Carvana fall so quickly and far? They initially borrowed a staggering amount of money to cover their growth and other costs. This includes spending $2.2 billion to purchase Car Global, a real-world used automobile auction firm. Due to a scarcity of supply, second-hand car prices were also soaring. For Carvana, this was a double-edged sword. On one side, this increased their need for used cars, but on the other, it forced them to raise their own prices to secure their inventory. Additionally, Carvana spent a lot of money on marketing at this time, including shelling out on a Super Bowl commercial with a potential ticket price of up to $7 million. Since that time, the world has started to alter. A return to normal has occurred, with many automobile buyers now visiting actual showrooms. Additionally, due to the unstable economy and rising loan costs, there is significantly less market for second-hand cars nowadays. In comparison to previous year, total used automobile sales are predicted to be 12% lower in 2022. Additionally, compared to this time last year, Carvana's earnings per vehicle has decreased by 25%. Carvana is in a challenging situation because of declining revenues, a high cost of goods for inventories, considerable debt servicing requirements, and other factors. Carvana's debt is a serious issue. Regarding that loan, with only $666 million in cash on hand at the end of September, total liabilities came to roughly $9.25 billion. In addition, diluted earnings per share for the previous 12 months were negative $9.05. Corporate bonds for Carvana fell significantly as a result of this stance. The Wall Street Journal reports that their 10.25% notes yield has increased to almost 30%. A 30% yield may appear attractive, but it actually belies a great deal of doubt about the company's capacity to repay the borrowed money. Prospects for Carvana don't seem promising. Not only is it problematic that Carvana is dealing with these problems, but they are also likely to get worse over the next few months. The rates on auto loans are at their highest points in 15 years, which means that the monthly payments for cars are much more now than they were a year ago. At the same time, people are grappling with high prices for everything from food to gadgets to rent to healthcare. And the average cost of a used automobile is very close to its record high at $28,200. Since the early 1980s, the Fed has raised interest rates at their quickest rate to date, and they don't appear to be slowing down anytime soon. Although it has started to decline again, inflation is still very high historically. In the upcoming year, we may anticipate a lot of more rate increases that will increase the cost of auto loans. The demand for Carvana's substantial inventory is probably going to continue to be severely impacted by this. Many analysts have cut their 12-month price expectations to as little as $1, including Seth Basham of Wedbush Securities. Assuming they live that long, please like, share, and subscribe if you enjoyed this video and would like to see more.